few weeks ago, right before tax day, I got a call from a dear friend of mine. For the purposes of this video, we'll call her Chelsea. Now, Wes and I have old souls, so it's not unusual for some of our friends to be in a different season of life. Chelsea's in her mid-60s and just recently retired. This was supposed to be the beginning of her golden years. But she called in tears. Last year, after chatting with some money managers promising big returns, she moved a large portion of her retirement savings into their care, thinking they could beat the market. Well, like 90% of active managers, they didn't. And here's where it got worse. Because of how the money was moved, she now owes a huge tax bill. She didn't earn any new income, just shifted investment, but it triggered a taxable event anyway. So not only did she not gain anything, she's had to sell even more of her holdings to pay the government, which means next year she'll owe taxes on that too. And now she's going back to work for at least another year. Not because she wants to, but because she has to, just to make ends meet. The retirement she worked so hard for, put on hold. She told me she felt a little embarrassed, like she'd messed up. But honestly, how was she supposed to know? No one ever sat her down and explained how this stuff works. I got off the phone wishing I could undo it all, but I can't, so I'm making this video instead. If we haven't met yet, hi, I'm Shannon, your Barefoot Librarian. After years of diving deep into research, earning my master's degree in holistic education, and working as a librarian and teacher, I've become pretty selective in the books that I dive into. So many claim to offer secrets or quick fixes, but more often than not, they leave me with vague advice and no real strategy. But when I picked up The Little Book of Common Sense Investing by Bogle, I knew this one was different, full of gold. But fair warning, it can be a bit boring at times. Bogle's approach is simple, practical, and based on years of wisdom that cuts through the noise. It's not about finding shortcuts or chasing after the next hot tip. It's about building real, lasting wealth through low-cost, long-term investing. As someone who's always on the lookout for straightforward, proven methods, I couldn't wait to dive in and share what I learned with all of you. And I'll do my best to liven it up a bit as we go along. Because if it helps even one person avoid that kind of heartbreak, it's worth it. If you've ever felt overwhelmed by investing, if you've ever trusted someone with your money and wondered later if it was the right move, if you've ever just wanted a simple, no-nonsense path to building real wealth, this post is for you. Let's talk about what actually works. Part 1, the basics of investing. Chapter 1, a parable. So Bogle starts the book with a simple idea. Investing doesn't need to be complicated. In fact, trying to make it complicated can actually hurt you. He's all about simplicity, especially when it comes to how we approach the stock market. Bogle's core message is this: instead of chasing the next big stock or listening to someone promising you big returns, just be in the market for the long haul. But how do you do that? By investing in something like an index fund, which tracks the market as a whole. No need to try to pick winners, you're simply betting on the growth of the entire economy over time. But here's the thing. People often get caught up in this idea of trying to beat the market. They think they can pick the right stocks and outsmart the system. Now, imagine this. The people who spent their entire careers studying the market, going to school for it, reading every financial report and working every day and night to understand it inside and out, even they fail to consistently beat the market. If these professional money managers can't do it, why should we try? Don't try to bet on the horses, buy the whole track. Instead of looking for the needle in the haystack, just buy the whole haystack. Bogle's message is simple. Don't overcomplicate it. Get into the market, stay in it, and let it grow over time. And here's the magic part, compounding. When you invest regularly, your money doesn't just grow. It grows faster the longer you leave it alone. This is the power of compound interest, and it's why investing early and staying patient leads to serious wealth in the long run. If you'd like more on compounding interest, check out my video on the richest man in Babylon. Even small, consistent investments can snowball if you just let them. So the biggest takeaway here? Keep it simple, sweetheart. Invest in low-cost index funds. Don't worry about trying to outsmart the market, and focus on long-term growth. The stock market will do its thing. You just need to get out of its way. Chapter 2, rational exuberance. So in this chapter, Bogle talks about something called rational exuberance, which is just a fancy way of saying that sometimes we get too excited about chasing big returns. It's that feeling you get when everything seems like a gold mine and you think you found the next big thing. Kind of like what happened to Chelsea when these money managers promised her big returns. But here's the thing. Shareholder gains should match business gains. If the company isn't doing well, the stock price won't just skyrocket out of nowhere, no matter how much we hope for it. That's where we get into emotional control. The stock market is full of ups and downs, and when you're in it for the long term, things aren't always going to look perfect. But here's the kicker. Getting too emotional, like panicking when the market dips, or getting really giddy when it shoots up, doesn't do you any favors. If you let those emotions drive your decisions, you'll end up making the wrong moves. Staying calm and sticking to a plan is key. Investing is a marathon, not a sprint. So keep it simple, focus on what really works, and remember, the market is going to have ups and downs. Stay in it for the long term and don't get caught up in chasing every shiny new opportunity, and let time do the heavy lifting for you. Part 2, the power of low-cost investing. Chapter 3, cast your lot with businesses. So if we're not trying to beat the market, what should we do instead? Jack Bogle gives us a clear path. Own the market by investing in businesses. Real working businesses through low-cost index funds. Here's how that works. An index fund doesn't just try to guess which stocks will win or lose. Instead, it simply mirrors a specific section of the stock market as a whole. For example, the S&P 500 index includes 500 of the biggest, most established companies in America. Think Apple, Amazon, and Coca-Cola. A total stock market index fund gives you a slice of every publicly traded company in the US, from giant corporations to tiny startups. There are even global index funds that give you exposure to international companies too. So when you invest in an index fund, you're not betting on one company, you're owning a tiny piece of hundreds or thousands of businesses at once. If one company struggles, no big deal. Another might be thriving. Your risk is spread out and your returns grow as the overall economy grows. Bogle loves this approach because it's based on common sense and capitalism. Over time, businesses grow. They solve problems, serve customers, and create value. As they grow, the value of the index fund grows with them. You're simply riding the natural wave of economic progress. The best part? Index funds are low cost because there's no expensive manager trying to outguess the market. Tax efficient, less buying and selling means fewer taxable events. Low stress. No need to watch the news, check the stock tickers, or panic sell during dips. And here's the kicker. This strategy consistently outperforms most actively managed funds. It's not flashy, but it's reliable. You're not trying to win the race, you're just hitching a ride with the entire field. And over the long haul, that's how real wealth is built. So instead of guessing, stressing, or hoping for a hot tip, you can invest calmly, confidently, and consistently, casting your lot with businesses and letting time, compounding, and human progress do the heavy lifting. Chapter 4, how most investors turn a winner's game into a loser's game. Here's the thing, the stock market is actually a winner's game, if you play it right. Historically, over time, the market tends to go up. If you simply stay in, stay consistent, and keep your costs low, the odds are ever in your favor. But here's where it gets interesting. Most investors lose. How? Not because the market's failing them, but because they fail to follow a simple plan. They make it complicated, and that's where the trouble starts. Jack Bogle puts it really simply. The relentless rules of humble arithmetic are on your side if you don't sabotage yourself. But unfortunately, most people do. They try to time the market, which is impossible to do consistently. They chase after the hottest stock picks or flashy funds, convinced they can beat the market. They pay high fees to money managers who promise big returns, but in the long run, almost never do better than the market themselves. Then when the market dips, they panic and sell low instead of staying invested. And the worst part? They overtrade, overthink, and overcomplicate the whole stinking thing. Doing too much is the problem. The best strategy is often doing less. Instead of trying to time the market or pick the next big winner, just keep it simple. Buy the whole market. Keep your costs low, stay the course. That's how you win. It's not about making a big bet on one stock or trying to get in and out at the right moment. It's about getting out of your own way and letting the market just do its thing. Now, Bogle isn't saying the market is easy, but he's saying that if you can just stay calm, stay invested, and resist the temptation to constantly do something, You're way ahead of most people. The biggest challenge isn't about being a genius investor, it's about emotional control. Most people let fear or greed drive them to make irrational decisions that end up costing them money. But if you can keep it simple and stay the course, you're already winning. Most people try to outsmart the system and end up outsmarting themselves. It's like playing a game with the odds stacked in your favor and then deciding to change the rules halfway through. But if you can keep things simple and just stick to the basics, you're already ahead of the game. Chapter 5 focused on the lowest cost funds. When it comes to investing, it's easy to get caught up in the excitement of chasing high returns. But the reality is that trying to beat the market, like Chelsea did, often ends up doing more harm than good. A lot of investors end up paying high fees, chasing hot stocks, or letting their emotions drive decisions, all of which erode their returns. Jack Bogle's strategy of low-cost index investing is the answer. Bogle's idea is simple. Don't waste your time trying to pick the next hot stock or outguess the market. Instead, just buy the market and let time, compounding, and growth work in your favor. Now, even if an active manager happens to beat the market for 1 year, here's the catch. That success doesn't usually last. The next year, the tables turn and the cycle starts all over again. The returns from one manager who beat the market are often wiped out by inflation, taxes, and manager fees. So even in that rare scenario, after all of these costs are factored in, the real investor return is nowhere near as impressive as it seems. Here's where Warren Buffett comes in with some timeless advice. The two greatest enemies of investors are expenses and emotions. Those two big E's. High fees and emotional decision-making are the biggest traps for investors. Think about it. Let's say you pick a winner. Great! But the fees, taxes, and emotional roller coaster you put yourself through in the process still chip away at your profits. It's like running a race where you get a great start, but you're carrying a heavy backpack that keeps slowing you down. The beauty of Bogle's approach is that low-cost index funds help you avoid those pitfalls. You're not paying high fees to fund managers who are trying, and usually failing, to beat the market. Instead, you're investing in a diversified low-cost fund that mirrors the market's growth, consistently and steadily. And when you minimize fees, you give your money the best chance to grow through compounding. Over time, that steady growth can turn into some pretty significant wealth. In the end, the message here is clear. Investing doesn't need to be complicated. Bogle's low-cost, long-term approach is the smart way to build wealth without getting caught up in the emotional highs and lows of trying to pick stocks. And I love that Bogle makes it clear he's just sharing this because it's what he does and what works for him. He's not getting any money from you out of this. His heart is really just to help the reader. Bogle's low-cost, long-term approach is the smart way to build wealth without getting caught up in the emotional highs and lows of trying to pick stocks. Stick with the simplicity of index funds and let your money grow. Because when it comes down to it, the most successful investing strategy is the one that's built on consistency, patience, and keeping fees as low as possible. That's where Bogle and Buffett both agree. It's simplicity that wins in the long run. Part 3, managing costs and risks. In Chapter 6, Bogle introduces dividends, which can be a powerful tool for investors who are looking to build wealth over the long term. Now, you might be wondering, why does Bogle mention dividends as a key part of his investment strategy? The answer lies in the simple power of passive income. When you invest in index funds, you're buying into a broad spectrum of companies that make up the market. Some of these companies pay dividends, a portion of their profits distributed to shareholders. Dividends provide a consistent source of income, which can be reinvested to grow your investment even faster. Or in some cases, you can take that money as income. The key here is that dividends contribute to long-term growth, often more than people realize. This idea of passive income is especially relevant to someone like Chelsea, who's looking for ways to build her wealth with minimal hands-on effort. With index funds, she doesn't need to consistently watch the market or pick stocks. She can rely on the natural compounding effect of reinvested dividends, which will continue to grow her investments without needing active involvement. The beauty is that dividends are an ongoing source of income that grows as the companies in her index funds grow and thrive. Now, dividends don't always have to be the centerpiece of your strategy, but when you own a broad, diversified set of companies through index funds, you're allowing those dividends to work for you over time. They become a bonus that accelerates wealth accumulation, particularly when reinvested, and can smooth out the bumps along the way. Over the years, this becomes an important part of why index funds, especially those that focus on companies that pay steady dividends, can be so effective in growing wealth without all the noise, complexity, and fees of active management. To wrap it up, dividends can be an investor's best friend. Oh, I got really excited about that. By putting your money in index funds that pays dividends, you can get the benefit of both long-term capital appreciation and a steady compounding stream of income. Over time, those dividends can turn a good investment into an even better one, helping you build wealth in a low-maintenance way while staying the course and letting the market work its magic. Chapter 7, The Grand Illusion, is all about exposing the myths and illusions that so many investors fall for, thinking they're getting ahead when, in fact, they're being misled. One of the biggest illusions? The idea that active management is the way to outperform the market. Chelsea's experience is a perfect example of this. She was sold on the idea that hiring a hotshot money manager would lead to bigger returns. But as we've seen, that doesn't usually work out the way people expect. Bogle calls this the grand illusion, the belief that you can consistently beat the market by choosing the right stocks or hiring a really good fund manager who has some magic formula. Now, we've already talked about how this just isn't the case. Professional money managers who spend their careers studying the market don't beat it consistently. In fact, over time, the vast majority of active managers fall short of the market's performance. Now, here's where it really gets interesting. The illusion isn't just the idea that active managers will beat the market, it's in the fees that are always charged to actively managed funds. These fees, which can be 1% or higher, eat away at your returns. And let's not forget about taxes on short-term capital gains, which often get triggered by the buying and selling in these funds. Add inflation, and you're left with returns that barely beat a simple index fund. So even when you're one of the lucky few who picks the winning manager in any given year, your actual returns after all the fees, taxes, and inflation are still likely to fall short of what you'd get with a low-cost index fund. The grand illusion is that we can outsmart the system, and really the market has a way of evening things out. So instead of trying to beat it, why not join it? This is where Bogle's message shines through. Get out of the race to pick winners and instead just buy the whole market. Forget about the illusions of active management and embrace the simplicity and effectiveness of index investing. When you invest in the entire market, you are essentially betting on the long-term success of the economy as a whole, not a handful of companies or a fund manager's guesswork. By focusing on low-cost, diversified index funds, you're cutting through the grand illusion and setting yourself up for real long-term success. The trick is to not chase the illusion of beating the market, but to stay consistent, stay in the game, and let your wealth grow naturally over time. It's simple, effective, and most importantly, real. Y'all, this part was so interesting to me. When Charles Schwab, the founder of Charles Schwab Investments, was asked why people invest in managed funds, he answered, "It's fun to play around. It's human nature to try to select the right horse." It's interesting, though, that most of Schwab's own personal portfolio is invested in index funds. Personally, I don't want to gamble with our retirement nest egg or the future of my family. I want to make smart, low-maintenance investments and then just let them grow without the stress of constantly trying to pick winners. The goal is to invest wisely, set it, and leave it to reap the rewards for years to come. And here's the thing Jack Bogle reminds us of. The buy and hold strategy that sounds so simple actually has a crucial part that most of us tend to forget. The hold part. It's easy to get excited about buying, but then when the market takes a dip, that's when we often make the mistake of selling instead of just sticking with it. The true power of investing lies in having the patience to let it grow over time without constantly second-guessing your choices. Chapter 8, Taxes or Costs 2. We've already talked about how fees can eat away at your returns, but there's another hidden cost that often goes unnoticed. Taxes and Uncle Sam. Now, I know taxes aren't exactly the most exciting part of investing, but they're a crucial piece of the puzzle. And here's the thing. Every time you or your fund manager buys or sells something in your portfolio, taxes are triggered. It doesn't matter if it's a profit or a loss, every transaction has the potential to create a tax liability. And when you're buying and selling actively, you're stacking up those tax bills. Take my friend Chelsea's experience, for example. She wasn't just dealing with high fees, she was also hit with taxes every time her active fund managers made trades. Whether it was a short-term capital gains taxed at a higher rate or long-term rates still adding up to significant tax bills, Chelsea wasn't fully prepared for how much taxes could eat into her returns. This is why low-cost index funds are a game changer. Since index funds typically have low turnover, meaning they don't buy and sell stocks constantly, you're not triggering taxable events left and right. Instead of worrying about taxes on every trade, you get to keep more of your money working for you, compounding over time. And when you do hold investments for the long term, you're eligible for lower long-term capital gains tax rates, which can save you a pretty penny compared to short-term gains, which are taxed at a higher rate. So here's the key takeaway. Don't just think about fees when considering the cost of investing. Taxes are a huge part of the equation too. The less you trade, the less you pay in taxes. Index funds help you keep both your fees and your tax bills low, so you can focus on the long-term growth of your investments instead of stressing over the next tax hit. Part 4, staying focused on long-term growth. Chapter 9, when the good times no longer roll. In this chapter, we get into something crucial for every investor to understand: market cycles. The stock market does not go up in a straight line. There are boom times and there are busts. It's inevitable. What's more important, though, is how you handle those ups and downs. When the market is soaring like it was when Chelsea first started investing, it's easy to feel like you're riding a wave of endless good times. But as we all know, that wave does not last forever. Eventually, the market takes a dip, or a big dip, and suddenly things aren't looking so rosy. This is exactly where the ability to stay calm and invest for the long term becomes your superpower. Chelsea's mistake was letting the fear of downturn dictate her decisions. Instead of staying steady and trusting the long-term potential of her investments, she panicked, selling at a loss, thinking she was avoiding future damage. But that decision, driven by fear, only worsened her situation. This is where Bogle's wisdom really stands out. He stresses that market cycles are a natural part of investing. Rather than letting short-term drops shake you, Bogle's philosophy is to keep your eyes on the horizon and stick with your strategy. The good times won't last forever, but neither will the bad times. The key is to stay invested, stay the course, and not let the market fluctuations push you into making emotional, panic-driven decisions. If Chelsea had been able to tune out the noise, stay calm, and let her investments continue to grow through the ups and downs, she would have come out ahead in the long run. The trick to weathering the storm is resisting the urge to act impulsively when the market hits a rough patch. Instead, focus on the fact that market cycles, while inevitable, are also temporary, and with time, they tend to work themselves out. Chapter 10, selecting long-term winners. When it comes to investing, one of the most seductive traps is the idea of picking individual stocks. It sounds enticing, right? You imagine yourself picking the next big winner, the company that will skyrocket in value and make you a fortune. But here's the reality. Stock picking is risky, and more often than not, it doesn't pay off. Chelsea fell into this trap. She believed that hiring a hotshot money manager and selecting individual stocks would allow her to pick the winners that would outperform the market. But as we've seen, the reality is far more complicated. Active management, where someone is trying to pick winners for you, often leads to underperformance. Even professional money managers with years of experience can't consistently predict which stocks will rise and which ones will fall. And let's not forget the high fees and taxes that come with this kind of approach. Those eat into your returns even more. Jack Bogle often emphasized that one of the biggest mistakes investors make is trying to pick individual stocks. The stock market over the long term is incredibly efficient. The prices of stocks are generally reflective of all that available information. Sure, there are times when a stock might be undervalued or overvalued, but consistently picking the right stock is like trying to pick the winning racehorse every single time. You might get lucky once in a while, but over time, the odds are against you. Instead of focusing on individual stock picking, Bogle recommends focusing on broad, diversified index funds. These funds automatically give you exposure to hundreds or even thousands of companies across different sectors, reducing the risk of betting too much on one company's success or failure. The beauty of this approach is that you don't need to be a stock-picking genius to succeed. All you need to do is invest in the market as a whole, stay patient, and let the long-term growth of the economy work in your favor. In Chelsea's case, she could have avoided a lot of unnecessary risk and expense by sticking with a simple, low-cost index fund. By investing in the broader market, she wouldn't have needed to worry about whether or not she picked the next big winner. Instead, she could have just stayed in the game, letting the market do its work and benefiting from its long-term growth. The lesson here is clear. When it comes to investing, forget about picking individual stocks and trying to outsmart the market. Instead, invest in the market itself and let the power of compounding and long-term growth do the heavy lifting for you. Chapter 11, reversion to the mean. There's a powerful principle in investing that many people overlook, and it's called reversion to the mean. It's a fancy way of saying that what goes up quickly often comes back down eventually. In other words, just because something performs exceptionally well in the short term doesn't mean it's going to keep doing that way forever. Chelsea's experience is a perfect example of this. She was drawn to funds that were performing well and assumed that the success would continue indefinitely. The stocks or funds that had outperformed the market in the past weren't guaranteed to keep doing so. But when you don't understand this principle, it's easy to get caught up in the excitement of past performance and think that that past is a clear indicator of future success. That's where things can go wrong. Reversion to the mean suggests that, over time, the performance of an asset, whether it's a stock, a fund, or an entire market sector, will tend to move back toward its long-term average. If something has been outperforming the market significantly for a period of time, there's a good chance that in the future, its returns will regress toward the market's average performance. This concept is important because many investors like Chelsea fall into the trap of chasing past winners. They see a fund or a stock that has done really well recently and assume it will continue to perform above average. But history shows that this often doesn't happen. Assets that have been doing well for a while tend to lose steam and return to the more average performance levels, while assets that have underperformed often catch up over time. This is why a strategy focused on low-cost index funds, where you're investing in the entire market and not chasing the hot stock of the moment, works so well. Instead of trying to predict which stock or sector will outperform, you're spreading your investment across the entire market, which includes both the high performers and the underperformers. You're betting on the market's long-term growth, and as the market fluctuates, those fluctuations tend to balance out in the long run, which is where the mean or average returns come in. In Chelsea's case, if she had taken a more diversified approach and not chased after hot short-term winners, she would have had a much better position for long-term success. Understanding reversion to the mean is crucial because it helps investors avoid the mistake of assuming past performance equals future results. The key is to stick with a strategy that's simple, low cost, and diversified, letting the market do its work instead of trying to predict its next move. The bottom line, don't get caught in the excitement of the latest hot pick or past performance. Stick with a strategy that's grounded in sound long-term principles and let the reversion to the mean guide your decisions, not the latest trend. Part 5, Trusting Simplicity and Avoiding Complexities. Chapter 12, Seeking Advice to Select Funds. When it comes to investing, many people think they need a financial advisor to guide them through the process. It's understandable. There's a lot to learn, and the world of investing can feel overwhelming. Trust me, I know. But here's the thing, you don't always need a financial advisor to succeed in investing. In fact, sometimes relying too heavily on an investor can do more harm than good, especially if the advice isn't aligned with your best interests. Just putting this out there, if you do talk to someone, make sure they are a fiduciary who is legally responsible to put your interest above their own. Fiduciary. It's gold. Jack Bogle's philosophy encourages self-reliance when it comes to investing, and for good reason. By understanding the principles of low-cost passive investing through index funds, you can take control of your financial future. You don't need to depend on a third party to tell you what to do if you understand the core principles that drive successful investing. Let's go back to Chelsea's experience for a moment. She thought that hiring a hotshot investor would give her an edge in the market, but as we've seen, that didn't work out well for her. In fact, many financial advisors have a vested interest in recommending certain funds. Those guys aren't fiduciaries, and often those funds come with higher fees for them, which might not necessarily be in the best interest of the investor. Some advisors are even incentivized by commissions, meaning they get paid when you sell and buy certain stocks, which can lead to advice that isn't necessarily focused on your long-term goals. So please, if you're going to talk to someone, make sure they're a fiduciary, someone legally required to put your best interests first. Bogle's message here is simple. When you understand the power of a low-cost, diversified index fund, you don't need to constantly second-guess your investments or rely on expensive advisors. It's about taking control of your own financial decisions. Yes, it's important to do your research and seek out trusted sources of information, but you don't necessarily need to pay a hefty fee to someone else for advice you can easily find on your own. Now, I'm not saying there's no value in seeking out professional advice, especially in complex situations, but when it comes to the core of investing, choosing low-cost, diversified index funds and staying the course is usually a pretty good bet. Bogle's principles give you the confidence to make those decisions for yourself. By following these principles, you can become your own advisor. You can focus on what matters, keeping costs low, staying invested, and letting your wealth grow over time. It's empowering to realize that you don't have to hand over your financial future to someone else. Bogle shows us that with a little bit of knowledge and a lot of patience, we can take control and manage our own investments wisely, without the confusion or unnecessary fees. So if you're feeling like you need someone to hold your hand through every investment decision, consider Bogle's advice. Take charge, stick to the basics, and let your money work for you over time. And if you want to talk to someone, make sure that they're a fiduciary. Chapter 13, profit from the majesty of simplicity and parsimony simplicity. This is often overlooked in the world of investing, where flashy strategies and complex products are marked as the path to success. But Jack Bogle's philosophy is rooted in the belief that the simpler, the better. And when you really step back and look at the landscape of investing, the beauty of simplicity shines through, especially when it comes to long-term wealth building. Take Chelsea's experience, for example. She was drawn to the complexity of active management, believing that choosing a few high-performing funds or trying to pick the next big stock would lead to higher returns. But in reality, this kind of strategy often leads to costly mistakes. Chelsea's portfolio ended up being far more complicated than it needed to be, and as a result, she paid so much in fees, taxes, and missed out on the steady growth that comes from a simple, low-cost investment strategy. Bogle's message couldn't be clearer. Simplicity works. By focusing on low-cost, diversified index funds, you eliminate unnecessary complexity. You don't need to constantly monitor the market, second-guess your decisions, or jump from one hot stock to the next. The beauty of index investing is that you're betting on the long-term success of the market, not on any one individual stock or sector. Over time, the market tends to rise, and by staying the course with a simple, diversified portfolio, you can see your wealth grow without the constant stress of trying to time the market or pick winners. What's even more striking is how this simplicity helps eliminate some of the most common pitfalls investors face. High fees? Gone. Emotional decisions driven by market volatility? Out the window. Complexity breeds mistakes, and the fewer moving parts there are in your investment strategy, the less room there is for errors to creep in. Bogle's emphasis on parsimony, that is, the idea of doing more with less, really hits home here. Rather than trying to manage 1,000 moving parts in your portfolio, focus on the essentials. A well-diversified, low-cost index fund strategy that gives you the best chance at long-term growth. It's a strategy that's not only simple, but also incredibly effective. The best part? The simplicity doesn't just make your investment strategy easier to manage, it also makes it more successful in the long run. When you focus on keeping things simple and staying invested, you can truly profit from the majesty of simplicity. Chelsea's mistake serves as a powerful reminder that the more complicated you make your investments, the more you risk missing out on the steady, reliable growth that comes from simply staying in the market, keeping costs low, and letting time do its thing. Part 6, Specialized Investment Vehicles. Chapter 14, Bond Funds. When it comes to building a well-rounded portfolio, bonds play an important role, especially when you're looking for a way to balance out the risk of stocks. Bonds are considered more stable, less volatile, and often provide consistent returns, making them a great option to help smooth out the ups and downs of the market. While stock investments have the potential for high returns, they also come with higher risk. And that's where bonds come in. Think of a diversified portfolio like a well-balanced meal. Stocks might be the main course, offering growth potential, but bonds, those are your veggies, bringing balance and stability to your overall health. And just like a well-balanced meal, you want a little bit of everything to make sure you're getting the nutrients you need without overdoing it on any one thing. By including bond funds in your index portfolio, you're essentially reducing your exposure to risk without sacrificing the opportunity for growth. The beauty of many index funds is that they often include a blend of both stocks and bonds, giving you the benefits of diversification right out of the gate. This balance helps to mitigate the risks of the market downturns while still providing opportunities for long-term growth. So, when you're putting together your investment strategy, think about bonds as a solid building block that can help keep your portfolio from swinging too wildly in the wind. Chapter 15, the Exchange Traded Fund, ETF. Exchange Traded Funds, ETFs, are an appealing option for many investors, especially because they offer the same broad diversification and low cost as traditional index funds. But what sets them apart is their flexibility. Unlike index funds that are priced once at the end of the trading day, ETFs trade on the stock exchange throughout the day, much like individual stocks. This means you can buy and sell them at any time during market hours, giving you more control over the timing of your trades. However, Bogle warns that this flexibility can be a double-edged sword. The appeal of being able to trade anytime may encourage investors to make frequent trades, which could lead to a more speculative short-term approach. But as Bogle has consistently emphasized, investing isn't about timing the market. It's about time in the market. Whether you're using an index fund or an ETF, the core principle remains the same. Buy and hold for the long term. ETFs may be more efficient than actively managed funds in terms of cost, But the same temptation to overcomplicate the strategy can still exist. Investors can choose from ETFs that track the broad market or target specific sectors, industries, or even themes. But Bogle's advice is clear. The more you try to fine-tune your portfolio by picking and choosing individual ETFs, the more you risk veering off the path of simplicity and long-term growth. The key takeaway here is that while ETFs offer flexibility and convenience, they still need to be approached with the same mindset as index funds. Stick to broad, diversified options. Keep your costs low and resist the urge to overtrade. Let your investments grow over time and avoid the temptation to jump in and out of the market based on short-term fluctuations. Simple, steady, and long-term investing remains the best strategy, whether you're using index funds or ETFs. Chapter 16, Index Funds that promise to beat the market. When it comes to index funds, the goal should always be simplicity and consistency. So you might be wondering, what about those index funds that claim they can beat the market? You've probably seen them advertised with catchy slogans like,
invest in the top performing sectors, or outperform the S&P 500.
But just like active management, these specialty funds often promise more than they deliver. Bogle's message remains clear. The goal isn't to beat the market, it's to join it. Most index funds that try to pick and choose top-performing stocks or sectors based on past performance end up underperforming over time when fees, taxes, and manager costs are taken into account. It's easy to be lured by the idea of a fund that could potentially beat the market, but the reality is that trying to predict the next best-performing sector or stock is nearly impossible to do consistently. The true value of index investing lies in its simplicity and reliability. By investing in a broad-based index fund that mirrors the performance of the entire market, you are removing the need for speculation and letting the power of time and compounding work in your favor. So while funds that claim to beat the market may sound tempting, remember that the simplest approach often yields the best results in the long run. Stick to broad market index funds to keep your costs low and let the market do its thing. It's a strategy that's not only more predictable, but also far more rewarding in the long term. Part 7, Historical Wisdom and Asset Allocation. Chapter 17, What would Benjamin Graham have thought about indexing? Benjamin Graham, often called the father of value investing, was a staunch believer in the power of careful analysis and patient investing, and avoiding speculative risks. While Graham didn't live in an era dominated by index funds, his core investing principles align closely with the philosophy behind passive investing today. Graham's approach was rooted in the idea that over time, the market tends to undervalue stocks, but only through disciplined research and long-term holding could you uncover these bargains. Although Graham didn't have the benefit of modern-day index funds, his investment style was far from speculative trading and high-cost management strategies that active managers often promote. Graham advocated for investing in a diversified portfolio of solid companies that were undervalued by the market and holding them for the long term. This, in many ways, mirrors the approach of low-cost diversified index investing that John Bogle champions. Graham would have likely appreciated the simplicity and effectiveness of indexing. Index funds embody the value of diversification, minimizing risks by avoiding the expense and uncertainty of trying to pick individual stocks. The idea that investing in the entire market rather than betting on individual companies or trying to time the market fits neatly into Graham's investment philosophy. Avoid speculation, keep costs low, and let your investments grow steadily over time. In fact, even though Graham was a proponent of value investing and picking undervalued stocks, he also understood that broad market diversification was a smart way to reduce risks. So had Graham lived to see the rise of indexing, it's likely he would have embraced it as a way to achieve long-term stable growth without the burden of high fees or the stress of active management. Chapters 18 and 19, Asset Allocation 1 and 2, Stocks and Bonds. The concept of asset allocation is one of the cornerstones of building a diversified investment strategy. Whether you're in the early stages of investing or nearing retirement, balancing stocks and bonds in a portfolio is crucial to managing risk and ensuring that your returns align with your goals. Index funds are a perfect vehicle for implementing asset allocation because they allow you to diversify effortlessly and cost-effectively. Stocks provide the potential for growth, but they come with higher volatility. Bonds, on the other hand, tend to offer more stability and can help smooth out the ride when the stock markets are turbulent. By combining these two asset classes in a well-balanced portfolio, you create a buffer against market fluctuations while still capturing the long-term growth potentials of equities. Bogle's emphasis on diversification couldn't be more relevant here. Instead of picking individual stocks or bonds or relying on a handful of active managers to choose for you, low-cost index funds give you access to the entire market across both stocks and bonds. This broad diversification helps reduce the risk of any one investment dragging down your portfolio, which is especially important for investors like Chelsea, who may have been overexposed to certain asset classes due to her previous investing strategy. Building a balanced, diversified portfolio through index funds doesn't have to be complicated. A simple mix of stock and bond index funds can provide the growth potential of stocks while offsetting the risk with the stability of bonds. This strategy, when maintained over the long term, helps investors manage market cycles and reduce the emotional impact of market downturns. For Chelsea and many other investors, focusing on a diversified mix of low-cost index funds could provide a steady, risk-balanced approach to investing, helping them avoid the pitfalls of concentration risk and volatility. By sticking to a long-term asset allocation plan and regularly rebalancing as needed, investors can position themselves for success without the stress of constant decision-making or worrying about trying to time the market. Part 8, Timeless Wisdom for Every Investor. Chapter 20, Investment Advice that Meets the Test of Time. When we look at the investment landscape today, it's easy to get caught up in the noise. Stock tips, market predictions, and the constant urge to chase the next big opportunity. But amidst all of this, John Bogle's timeless principles continue to stand strong. His advice, investing in low-cost, diversified index funds, has proven over time to be the most effective strategy for most investors. Bogle's advice transcends market trends and emotional reactions to the day-to-day ups and downs of the market. The beauty of this approach is that it works for people of all experience levels, from beginners to seasoned investors. He teaches us that the power of investing doesn't come from trying to outsmart the market, but from simply staying in the game and letting the market do its work over time. This advice is as true today as it was when Bogle first introduced it, and it's the same advice that could have saved Chelsea from the mistakes she made: overtrading, paying excessive fees, and chasing after market fads. Ultimately, Bogle's principles are about long-term thinking, simplicity, and patience. By sticking to a low-cost, diversified portfolio and resisting the temptation to overcomplicate things, investors can achieve consistent, reliable returns. It's not about beating the market. It's about staying invested and letting the power of compounding work its magic. In the end, this simple, proven approach is what helps investors avoid the mistakes that lead to frustration, anxiety, and poor financial outcomes. All right, let's wrap this up. The core message of The Little Book of Common Sense Investing by Jack Bogle is clear. Investing doesn't need to be complicated. The best strategy is often the simplest and most consistent one. Rather than trying to time the market or pick individual stocks, Bogle encourages us to focus on low-cost, diversified funds and let our investments grow steadily over time. The key is staying disciplined, keeping costs low, and avoiding the common illusions that derail your success. As always, the book will be linked below so you can dive deeper into these life-changing strategies at your leisure if that's something you'd like to do. For Chelsea and many other investors, the key takeaway is to trust the process. The mistake comes from trying to outsmart the market, when the real win comes from keeping things simple and staying the course. Over time, consistency and patience pay off. If this resonates with you, I would love to hear your thoughts, insights, questions, and disagreements in the comments below. And for even more insights on building wealth, check out my recent video on the richest man in Babylon, where my husband and I more than doubled our net worth because of lessons we learned from ancient parables. It's filled with timeless financial wisdom that pairs perfectly with the principles we've discussed today. That's all for now. Take care, stay curious, and I'll see you next time.